Yeah, I think it's investing, ahead of those trends. Using some examples, a company like TransUnion, which is in the credit scoring industry. So if you buy a sofa or a car or a TV and you buy it on credit, you need a credit score, and TransUnion provide that. But what they did 5 years ago was to invest in a cloud-based infrastructure and a cloud architecture for their business. And that allows them to give a much faster service to their clients, but they can also provide a time series, so a series of credit scores rather than just one snapshot for that individual. So that's some really rich data that a lender wants to get, and they can charge a premium for that. So they're growing fast, they're gaining market share, and they're doing it profitably. And that's exactly the type of company that we're looking for. So, investing ahead of that technological change and really shaping the industry as it transforms is how you stay relevant. But it takes a long time to build that position, and that's something that our long-term thinking and those forecasts really try to take into account. Yeah, there's a range of things. I think if you look even further back, you go back to the 80s, and Japanese banks were the biggest companies in the world. And in the 90s, it was probably US consumers and other things. And then 2000s it's tech, and here we are today with the internet giants and all the rest of it. So it's always evolving. So the first thing that probably drives that is just the industry that you're in, and how profitable and how in favour that is at that moment. But the second thing, just below the kind of mega caps and who those leaders are, why return on capital might fade for the average company, is more around management incentives. And if they're just incentivised on EPS growth, they might not reinvest in the business appropriately. They might gear up the balance sheet to buy back stock. And just gearing up the balance sheet to buy back stock, you might meet your EPS targets, but if you're not reinvesting in your assets to stay competitive, you're going to undermine the long-term positioning of your company, and that causes businesses to drop in their return on capital. Yeah, I think when you can see that return on capital changing, and maybe they're losing market share, or it's not an intentional investment that causes that. There are many companies that have good returns, and if they make an investment that is near-term dilutive to returns but has a really strong strategic rationale, think about Tencent growing their payments business. They've grown that payments business, which has cost them in terms of short-term profitability, in terms of overall margin. But the long-term potential for that payments business to provide banking to small merchants, to provide working capital support, to provide even payroll solutions to those companies, that provides a really long-term margin and profit opportunity, which is additive to that long-term return on capital. So there are good reasons for falling returns, but there are also bad ones where you're failing to invest, you're losing market share, and that competitive edge is dwindling, and that's when we would sell the position.